Americans return to space as Discovery clears the tower.
TTMtrades. Hey, today we're going to be talking about one of my favorite indicators, the Bollinger Bands. One that I use and I've been using from day one since I first read about them and actually applied them to a chart and fell in love with them. And I have never deviated from them since. I've only added and built upon trading strategies. So today we're just going to be going over the basics of Bollinger Bands. That way you have a better understanding of them. So yeah, let's just jump right into Bollinger Bands. All right, so for our learning objectives, okay, this is what I want you to take from this, okay? I want you to know what are Bollinger Bands, how Bollinger Bands calculated, how Bollinger Bands constructed, understand the different concepts and theorems applied to Bollinger Bands, what information Bollinger Bands provide you as a trader, and John Bolilnger 15 basic rules he applies to his Bollinger Bands. Now, what are Bollinger Bands? Okay, first Bollinger Bands were developed in 1983 by the one and only John Bolilnger. Okay, volatility is the key reason they were constructed. Mr. Bollinger was into the options market at that time back in the 80s, and if you trade options, then you know volatility is a big deal. So he wanted to be able to kind of identify breakouts and moments of volatility in the said derivative he was trading. So this is one of the main reasons that they were constructed in the first place. Now, you have a middle Bollinger Band is a 20-period moving average. By default, is based on the amount of trading days in a month. So you know there's 365 days in a year, but if you eliminate the weekends and the holidays, that leave us roughly 252 trading days a year, give or take 21 to 22 trading days per month. So that's where he came up with the 20-period moving average. Now, it provides the upper and lower limits of price action. Limits are based on a standard deviation of prices from the middle Bollinger Band. It was designed to contain a 95% of the price action in normal markets. Keyword normal. Bands widen when volatility increases and contracts when it decreases. Adaptivity is very important as bands adjust and recalculate with the price action. So the calculation of Bollinger Bands, okay? So by default, you have a 20-day simple moving average as your middle Bollinger Band. The upper band is the 20-day simple moving average plus the 20-day standard deviation of price times 2. Same with the lower Bollinger Band, and that should be a minus. I have a plus right there, but the lower band is the 20-day simple moving average minus the 20-day standard deviation of price times 2. So here's an example, right? Understanding the calculation. Standard deviation is important to understand as it gives you an idea how much the price has deviated from its middle Bollinger Band based on the simple moving average you decided to use, okay? Me personally, I use a 30 simple moving average, but we're going to stick with the default 20-period simple moving average. So if we go up here, as I bring my mouse around, if we look at the price action on this ticker right here on 29 May of 2009, the price was $90.70, okay? On average, the middle day 20-day simple moving average was sitting at 88.71, okay? That is the 20-day simple moving average. So the actual price of the stock itself is at 90.70, and based on the 20-day average, the middle Bollinger Band is sitting at 88.71. Now, your 20 standard deviation is sitting at $1.29. So what it's saying is, based off the past 20 days, okay, the price has deviated roughly $1.29 above the 88.71 and below the 88.71. Okay, it's deviated from that middle Bollinger Band roughly about $1.29. So the way we get the upper band is the 20-day simple moving average right here plus the standard deviation times 2. All right, so 88.71 plus the standard deviation of $1.29 times 2, that equals $2.58. That will give you an upper Bollinger Band of 91.29. Now the same goes for the lower Bollinger Band. We're just going to subtract. So again, lower Bollinger Band is 20-day simple moving average minus the standard deviation times 2. So 20-day simple moving average, 88.71, times the 20-day standard deviation of $1.29, which is $2.58. So 88.71 minus $2.58 will give you 86.12, and that will be your lower Bollinger Band. And that is how your Bollinger Band is constructed. So you have a simple moving average of 20 days in the middle, and then that upper Bollinger Band and that lower Bollinger Band is constructed based off this formula right here of upper band 20-day simple moving average time plus the standard deviation times 2, and the same for the lower band, except you're going to add 1 and you're going to subtract the other. Now, standard deviation. We need to understand what standard deviation is, because that is how the upper and lower Bollinger Band is constructed based off the 20-day simple moving average. Okay, so the standard deviation measures the amount of variability or dispersion around an average. Dispersion is the difference between the actual value, which would be the actual ticker price of the stock at that time, and the average value, which would be your actual moving average, which would be your middle Bollinger Band. So the dispersion is the difference between those two. Now, the larger the dispersion or variability is, the higher the standard deviation. Okay, so over the course of the 20 days or whatever your super simple moving average you choose to use is, the larger that dispersion is from that moving average, the higher the standard deviation will be. Okay, which means your bands will be a little bit wider to show you the variability in the price action itself. Now, the smaller the dispersion of variability is, the lower the standard deviation will be, meaning that your bands are going to be a lot more tighter and constricting on the price action, because it isn't that much fluctuation in the actual stock itself. Now, standard deviation is used to measure expected risk and determine significance in price movements. Okay, so what does that mean? Okay, if you have a 20-day SMA with a standard deviation, as we just looked at, of $1.29 over a span of 20 days, and then going into tomorrow the price action jumps $4 to $5, then that right there is a significance in the price movement, because that is a way bigger jump than $1.29 on average from what it's been doing the past 20 days. Okay, so that should catch your attention, and kind of what is going on with this stock for it to be moving in such a significant manner. Okay, now both the upper and lower band are constructed based on the average deviation from the average price, which is the middle Bollinger Band. Now, volatility is very important. Main reason the bands were created in the first place by Mr. John Bollinger. The idea is that price is not cyclical in a regular sense, nor forecastable using cycles, but volatility is both. Okay, so what does that mean? Some traders think that price action moves in cycles, and to a degree it does. Okay, it's not a predictable cycle every time, but you know, the cycle for price action normally is sideways movements for consolidation, breakout in the uptrend, sideways consolidation as far as the uptrend at the top, break down into a downtrend. So either you're moving sideways or you're moving in an uptrend or downtrend, right? Those are the cycles for price action. Now for volatility, you can do both, right? Volatility moves in cycles, and you can forecast it, because the Bollinger Bands help you see when the next cycle is occurring. Okay, with volatility, it's either doing two things. It's either very low and constricting, meaning the price action isn't fluctuating too much, and or it's very high and the price action is dispersing from its simple moving average at a very fast rate. Okay, so in that sense, the price action is either constricting and or it's expanding. All right, and that helps us see that cycle, and it's forecastable, because if we're already looking at a stock and it has high volatility, then we know what comes next is low volatility, because that price action has to consolidate sooner or later. A stock can't just continuously move at a fast rate in an uptrend non-stop for years to go. It has to slow down sometime soon, consolidate, and then from there decide if it wants to move back in another uptrend and or move down in a downtrend. Okay, so that's what makes volatility forecastable, and also the fact that it moves in a cycle. Now you can see a regular pattern of the expansion and contraction of the bands as they reflect volatility around an average, as we was just talking about. As the bands expands, it symbols the underlying stock is moving at a fast rate outside its band. And as the bands contract, it symbols the underlying stock is consolidating in a sideways manner, allowing the bands to tighten, to constrict around the price action. Now, the most interesting conclusion is that low volatility will soon lead to high volatility, and that's that cycle we was talking about, known as the squeeze followed by a breakout. And high volatility will lead to low volatility, which is consolidation of the current trend prior to it reversing or continuing, whether it's a downtrend and or uptrend. Now, what I want to do is I want to go over some of the concepts and theories that are applied to Bollinger Bands, okay, with the stock market and a lot of the indicators that are used, simple moving averages. There's a lot of mathematicians and statistics that are put into the stock market. So, of course, these are some of the concepts and things that are applied to Bollinger Bands. One of the key concepts applied to that has been applied to Bollinger Bands is the normal distribution statistical concept. So what this pretty much is for an example, right? First, let me show you what it looks like. And that's the chart of the normal distribution. And we're going to go over this in a little more detail. All right, but let me give you an example. So the normal distribution statistical concept and how the concept is applied to Bollinger Bands. So for example, take all human beings, let's just say in the United States, and measure their height. Okay, if we take their height and we plot it on a chart, right, from 4'5" all the way to 7'6", you will begin to see a normal distribution with a bell-shaped curve around the average height. Most will be grouped around the average height, forming the top of the bell. And as you get away from the average, there will be even fewer people, right? So as you get to the tall and short extremes, i.e. one short extreme being 4'5" to the left of that bell, you will see that there's fewer people. And then as you get to 7'4", which is to the right of that bell, you will see that there will be fewer people, right? So the take on that is, to the left and right of the average, right? Let's just say the average human being, give or take, is anywhere from 5'5" to 5'10", right? On average. As you get to the left and right of that, then you will begin to see there are far fewer people, right? So to see people in those ranges of height of 4'5" and 7'4", that's a bit extreme. And I don't want to say extreme as if that's a bad thing, but I'm just saying like that's more rare, right? That's not common. Okay, so as we move on to the actual graph itself and how they've taken that statistical concept and tried to apply it to Bollinger Bands is, if you look here, the normal distribution, you have your mean or your average in the middle, right? So this would be your simple moving average or your middle Bollinger Band. By default, it's 20 periods, okay? Now what it's saying is, with a one standard deviation, right, deviating from its average to the left or right, because if we was to take this and turn it sideways, right, then that mean or average would run from left or right in a horizontal manner, and now we would be talking about an upper and lower Bollinger Band, right? So just visualize that. But we're going to continue looking at it in a vertical manner. So you have your mean or average in the middle, and it's saying with a one standard deviation plus or minus, price action should only move, a one standard deviation should contain 68.26% of said price action. Okay, so if you have a one standard deviation, all right, based off a plus or minus one standard deviation from the mean or the average. It should only deviate 68.26%, right? 34% to the left or 34% to the right for the most part. Now, John Bollinger wanted to use a 2 standard deviation because he wanted to try to contain 95% of the price action in the market. All right, so based off a 2 standard deviation plus or minus either side of the mean or the average, then you will see that 95.46% fall within a 2 standard deviation from the mean. Okay, as you see here, if you add it up, 13.59 plus 34.135 along with 34.135 and 13.59, that will give you a 95.46% containment of the price action. How norm, okay, that is. Okay, anything to the left or right of that 95.46% of a 2 standard deviation, then it begins to get a little rare, right? As you do a 3 standard deviation left or right of the mean, then you start to get into the lower, the fewer, the less common of 2.14, and then again 0.135%, 0.135%, right? So taking that height concept, your 5'5" to 5'10" personnel would fit right in this upper bell because that would be the most common height, right, among Americans, give or take. Okay, I don't have any proof on that. We're just going off of average height. All right, as you start getting to the left of shortness, you know, 5'4", 5 foot even, 4'8", 4'5", 4'2", then it's a little more rare on those heights. Again, as you go to the right and you get, you know, taller into the 6'1", the 6'4", the 6'6", the 7 feet, the 7'5", 7'7", then it gets rare and less. Okay, so what they do is they take this same concept and they apply that to Bollinger Bands. So what they're saying is, if you have a mean or average of 20, right, the price action should be contained within a 2 standard deviation 95% of the time. Okay, again, if we take this and turn this sideways, then you have a upper band and a lower band, which you mean right in the middle, which is your middle Bollinger Band. Now what they're saying in the market is, with a 2 standard deviation, it's supposed to contain 95% of the price action. If a stock was to go on a strong uptrend and break out above that upper Bollinger Band of a 2 standard deviation, then that is a very rare occurrence. Okay, and that can mean one of two things: either that stock is overextended and oversold and it's going to pull back, and or it's on a very strong uptrend to the point that it's very rare that a stock moves that fast and there's a lot of buying behind it, a lot of momentum, and maybe some good news came out about it, so on and so forth, right? So it's showing the rarity of a stock pushing past that 2 standard deviation. If a stock falls below that 2 standard deviation, because again, a 2 standard deviation is supposed to hold 95% of the price action, then that means there's a lot of selling and there's something going on with that stock, whether there's bad news, give or take. But for some reason, a lot of people are dumping said stock and it's going outside of that lower Bollinger Band. And now we're pushing into the rarity of a deviation, because now we're pushing into the areas of where 2% of the price action normally hangs out. And if it continues to push even harder down to a strong downtrend, now we're pushing into an area where 0.13 of the price normally hangs out at, because a stock normally doesn't move that fast outside of that deviation. Okay, so that's the concept of normal distribution that is applied to Bollinger Bands. Now, and let me go back to that, and the normal distribution applies to your standard deviations of a 2 standard deviation. Okay, just to summarize that. Okay, so what they're saying is, if you have a middle Bollinger Band and a 2 standard deviation top band and a lower band, then the price action should stay within those 2 bands 95% of the time. Okay, if the price action was to ever break out above and or below, then that's very rare, and that goes to say that that stock is in a strong uptrend or a strong downtrend, or again, it could be oversold or overbought, give or take. Okay, So that's how the normal distribution concept applies. Now they also have something called a central limit theorem. Okay, it is understood stock prices are not normally distributed, and the statistical rule may not hold over the life the stock prices due to the random fluctuations. Okay, so even when the data is not normally distributed in reference to stock prices, a small random sampling will produce a normally distributed subset for which the normal distribution statistical rules will hold. Okay, hence the reason we use a simple moving average, a middle Bollinger Band, to apply the normal distribution statistical concept to a small set of price data in reference to the stock market. So what does that mean? Okay, the central limit theorem. Okay, so as it says here, it is understood the stock prices are not normally distributed. Okay, as we was just talking about in the last concept, the normal distribution. Okay, they understand that stock prices are not normally distributed because over the lifespan of a stock, the price will fluctuate so much at different price ranges that you cannot have a normal distribution. Now, as far as the height concept, can we have a normal distribution theorem? Yes, we can. Okay, to a T, we can, because us as human beings, we're not fluctuating in height all over the place, right? We don't have someone who's 1'1" and then someone who's 10'5" and someone who's 17'8" and then someone who's 5'9". No, we normally range, give or take, from what I've seen, from 4'5" up to 7'6", with a lot of the normal distribution of height falling right around that 5'5" to 5'10". Okay, so we can have a normal distribution concept with height, but with the central limit theorem, that says we can't have a normal distribution concept applied to stocks because of the fluctuation of the stock and the different price ranges it hit over the lifespan of that stock, right? So with central limit theorem, what they do is they say, okay, we can't apply the normal distribution concept to it wholeheartedly, but if we take a small set of data during a specific time frame, then based off the amount of data we have, we can take the normal distribution concept and apply it, right? Hence the reason we use a simple moving average, the middle Bollinger Band, to apply the normal distribution statistical concept to the small set of price data in reference to the market of stock, right? So give or take, let's say Apple's been around for some years, many years. Okay, we couldn't apply that normal distribution concept to Apple over its lifespan, right? Because Apple has ranged in a lot of different prices. But if we take a 20-day sample, if we take the last 20 days of Apple stock prices, now we can apply that normal distribution theorem to those last 20 days, and based off the last 20 days of price action, now we can look at, based on the standard 2 deviation of the middle Bollinger Band, if the prices are moving sporadically outside the band and or staying within the band, right? So that's the central limit theorem, okay? And that's how the middle Bollinger Band is applied, all right? So again, your top and lower Bollinger Band uses the normal distribution concept with the standard deviation, and then your central limit theorem helps establish a middle Bollinger Band as far as a moving average, because we cannot capture the entire life of a stock and utilize that concept. So what we do is we take a snapshot, a moving average, whether it's 20 periods, and then we apply that concept, and then we look at the extremes based off the last set of the last 20 sets of the stock price data. Now, the last concept is regression to the mean concept, okay? It is a statistical concept often related to Bollinger Bands, okay? The concept is all things will eventually come home, okay? So for statisticians, home is the mean or average, known as the middle Bollinger Band, okay? It implies that prices at the edge of distribution, upper or lower Bollinger Band, will revert back to its mean, the middle Bollinger Band. This is the statistical concept applied to the technical terms overbought and oversold. All right. So again, as prices hit the edge of distribution, again, that upper and lower Bollinger Band, that's when the concept of a stock being overbought or oversold came from. Okay. Hey, the stock has been moving in this range over the course of these many days. All of a sudden, it's extended this high or this low in the course of a small amount of days. So this stock is definitely overbought or oversold, right? That's where those statistical concepts come from and have been applied. Now, understand this is a concept applied to financial instruments, and the concept is not as strong as it should be. Okay, so tags of the band are not automatic buys and sells with the average as a target, as this regression to the mean concept applies. So be sure to use other indicators to confirm tags of the bands or breakouts of the bands. Now, some key points I want you to take from all of that, okay? Key points to remember. Statistical rules hold generally, but not absolutely for Bollinger Bands, okay? I.e. the normal distribution statistical concept. Regression to the mean is not as strong as it should be. Use indicators to confirm band tags, and volatility is cyclical even when price is not. And high volatility will soon lead to low volatility, and low volatility will soon lead to high volatility because volatility is cyclical, like we just said. All right, let's move on. Now, what information does Bollinger Bands provide? Okay, Bollinger Bands help you identify consolidation periods, also known as the squeeze. They help you identify breakouts, strong trend and direction of the trend, oversold levels, overbought levels, helps you identify volatility, support, resistance, and patterns. Okay, so we're talking about one overlay, one indicator that helps you identify all of these different things, okay, based off one overlay. So let's talk about consolidation, okay? Now, the most popular topic on Bollinger Bands is a concept called the squeeze, okay? This concept fascinated me 3 years ago when I started reading about it. And then when I actually started applying it to charts, it really blew my mind to see that the stock would play out in the manner based off the squeeze concept, okay? Now, a prolonged contraction of the bands, contraction is when the bands are beginning to tighten, as you can see here. The bands are very volatile, and now they're beginning to squeeze on the price action. Bands were volatile, and then they begin to squeeze on the price action right in this area. Okay, so that's a contraction. A prolonged contraction of the bands that follows with a subsequent explosion of price activity. Okay, that's the squeeze. Bollinger Bands are driven by volatility, and the squeeze is a pure reflection of that volatility. When volatility falls to historically low levels, the squeeze begins to happen. This happens when the price action is not fluctuating very much and tends to move in a sideways motion, demonstrating that the bulls and bears are at an equilibrium as far as buying and selling. Sooner or later, one of the two sides will take complete control, which will cause the stock to explode to the upside or downside. As we said earlier, volatility is both cyclical and forecastable. You will be able to see the bands contract on your chart, but an indicator known as the Bollinger Band width will give a better view from an indicator standpoint on that contraction. So let's look at this chart right here, right? So Tiffany and Company. All right, so a couple of times where you can see consolidation happening, right? This stock is in a strong uptrend from February all the way up to April. When it gets to early April, the stock is no longer, you see as it pushes that upper band, pulls back, pushes the upper band again and tags it, pulls back, pushes the upper band, tags it, and then it pulls back. But you can see the stock is, instead of running in an upward trend, it starts consolidating and moving sideways, right? As it does this, it shows that the Bollinger Bands, which were once wide and expanding, are now beginning to contract on the price action because it's catching up with the volatility in the price. As they begin to contract and the bands became tight like that, we recognize that as the squeeze, meaning that price action is now consolidating. That upward trend that was strong has now begun to move sideways, and it is no longer volatile, but now it is at a very It's at a very contracting point where the price action is no longer swinging upward or downward, right? So right behind that, we normally know that there's normally going to be a big move back to the upside and or the downside, and that's when we start using indicators to identify which direction the stock is going to break out in. And then as you see here, it immediately broke back down to the downside, tagging that lower band over and over and over. Now it recovered and then it started moving sideways again, finding support right in that 89 area and resistance right at that 95 area. So as the bands were once wide, they begin to constrict on the price action to reflect the sideways movement and also reflect the support and resistance. As you can see, the band came all the way down and then started turning sideways to reflect that $95 resistance the price action was struggling at. And then the band here began moving to the upside and then to reflect the $89 support. So again, as the bands begin to constrict, again, the Bollinger Band width, as we mentioned, you can see that the Bollinger Band width is falling to a low level to show that the bands are beginning to constrict. As this average begins to converge on it, we know that a breakout is soon to happen here soon. And then as that crossover gets ready to happen, the stock breaks out to the downside again on strong volume. Again, it gets a complete resurge, a lot of buying, and then instead of it coming back down and retag that lower band, it holds and begins to move sideways again. So Bollinger Bands that were once wide are beginning to constrict again to reflect the support and resistance. So the bands is beginning to move up to that $86 and flatten out to show the support. And then the band is beginning to pull down to try to reflect the $93 resistance. But then again, it immediately moves in a big move. And we know that the bands are constricting because, again, once again, it's below its average. As the Bollinger Band width begins to turn flat, then we know that the price action is about to make a move. And then you get this big breakout to the upside as the price action is starting to move in an upward trend with a buying volume behind it. All right. So these charts are pretty current, like they're current, like right now current. So again, the price action has broken out again and it's moving sideways. The bands, which were very wide, reflecting this big move, are now beginning to catch up to the price action and reflect the resistance and support of this sideways consolidation. And again, like we said, volatility is cyclical. Low volatility, high volatility, low volatility, high volatility, low volatility. Again, the averages are beginning to converge on one another. So what do you think is next in the cycle, right? This is what makes volatility forecastable, right? Volatility is low, bands are constricting. You should get a breakout here soon, whether that's to the upside or downside. That is for you to utilize other indicators and do due diligence and technical analysis on the stock and pay attention to the volume and everything, okay? But this is why volatility is very forecastable, all right? And the squeeze concept is a big deal because it helps us identify when a big move is coming, and that way we can start setting up to trade into that big move once we get a sign of the stock breaking above previous resistance levels or breaking below previous support levels. All right, next we're going to talk about trend, okay? Now, a trend moves above or below the bands. A move above or below the bands are not signals per se, okay? As Bollinger puts it, moves that touch or exceed the bands are not signals, but rather tags. On the face of it, a move to the upper band shows strength, while a sharp move to the lower band shows weakness. The upper and lower band is 2 standard deviations above and below the 20-period simple moving average. So it takes a pretty strong price move to exceed these bands, right? Hence the normal distribution concept that is applied to Bollinger Bands, okay? A constant tag of an upper or lower band is considered walking the bands. As the trend strength is strong, as the price action makes the higher highs or lower lows while continuously pushing outside the band. In most cases, the price action will remain above or below its middle Bollinger Band during said trend, and any pullbacks to its middle Bollinger Band would allow entry opportunities to follow the trend. So here we have Tesla. All right, we started watching Tesla back in early October due to the Bollinger Band squeeze concept and watching the price action consolidate. So Tesla has two trends. As a matter of fact, Tesla has three different trends going in this one image. So here you have that downtrend we was talking about. The price action is failing to break above and hold above its middle Bollinger Band, its average. Okay, so as you see here, price action pushes up into the middle Bollinger Band, fails, gets rejected, pushes up and breaks above that middle Bollinger Band, fails to hold, gets rejected, tags the lower band, tries to recover, pushes up to the middle Bollinger Band, couldn't even make it, rejected, fails, starts to fall again, tags the band, pushes up again to try to recover, breaks above that middle Bollinger Band. Based on that high volume and that sell-off, you can see that the price action fails again, and it holds, it stays within the band. So if you didn't have all this data set to the far right of it, you would think, well, maybe this thing is trying to recover. But again, a lot of signs are showing you that it's not going to go on an uptrend, and it's constantly getting rejected because pushes up the middle band, rejected, middle band, rejected, pushes up again, rejected, and then it fails and tags the lower band, going back into a downtrend. Another push up to try to retest that middle band, doesn't even make it, fails and goes back into a downtrend, continuously tagging that lower band. Okay, so that's what a downward trend looks like. Now, something happened in June to where a lot of buying occurred. It may hit a support on a bigger time frame, monthly time frame or something, but a lot of buying came in, and the price action again tried to recover, and as it got to that middle band, it broke above and began trending up. Okay, even though it gapped down, it held within the bands and started trending up again. All right, now again, it didn't hit our radar till early October when we saw the price action was one staying within the bands, showing that the downtrend was done and it was in a sideways consolidation movement, as we was just talking about. Price action support was sitting right at 211 early, and rejection was at 253. We see the bands adjust here to adjust to that 211, and we see the band adjust here to adjust to that 253. Each pullback towards this middle band, it goes back up and it holds. Each pullback goes back up and holds, and at the same time, we're creating higher highs and higher lows, right? So you have a higher, you have a low established, or you had your first low established there with a higher low, a high with a higher low, a higher high, and then it pulls back, and then you get the gap up with the breakout out of the bands. Now, contrary to the downtrend, it's going to do the exact opposite on the uptrend. Tags that upper band, pulls back, starts his run up, can't reach that upper band, showing that the buying power is weakening. So the stock pulls back, finds support on that middle band where buying comes back into play, runs up outside that upper band, tagging it nonstop, pulls back, begins running back up again, pulls back, runs back up again, pulls back, runs back up again. What do you think is going to happen? Tesla is probably going to pull back. Okay, and with that being said, if I'm playing options, I'm going to put a couple puts, allow Tesla to pull back, and then if the uptrend is strong, it will stay above that middle Bollinger Band and will continue to uptrend. Okay, but that's what Bollinger Bands are good for. It's good for helping you identify the trend and to trade with the trend. So clearly you have a downtrend, failure to hold above the middle Bollinger Band. You have a period of consolidation as the price action goes above and below the middle Bollinger Band, but staying within the bands overall. Okay, up, down, up, down, up, down, up, down, and then finally breaking out to show that now we're in a uptrend. All right, moving on. Oversold and overbought levels. Okay, Bollinger Bands were created with a 2 standard deviation in mind to contain about 95% of the price action in a normal market. Now, after running 10 years of tests on 6 different markets, John discovered the bands contained 88 to 89% of the price action with the 2 standard deviation. Okay, so the aim was 95% per the normal distribution concept. When he ran this testing, he found out that the bands were only containing 88 to 89% of the price action. Which isn't bad. It's only about 6 to 7% off, so that's not bad at all. So a move outside of the band showed strength, and that the price action could be oversold or overbought, forcing it to soon return back within the normal range of the bands, called mean reversion, which is one of the theories we was talking about earlier. This especially holds true when the market is ranging or consolidating sideways. The bands will adjust to the upper and lower limits of the price action, giving you buy and sell signals until you see a breakout or breakdown of the price action into a trend. So going back into Tesla, we saw that the upper and lower limits established, also known as resistance and support. And then moving forward, looking at, I think this is Exxon Mobil. Exxon Mobil is in a downtrend, and then again it established support here at 66.17, broke out to the upside 74.28. When it pulled back, the plan is to see if it pulls back and goes back outside the band, because then that will let us know it's still on a continuous downtrend. But when it pulled back, it stayed within the bands, whereas the bands adjusted to that 66.17, $65 to $66 range, and then when the price action hit the band, it actually recovered and stayed within the band. So that lets us know that maybe we are in a sideways trend right now. So now it's been established that 65 to 66 is support, and 74.28 is the possible resistance. So the bands will adjust as the price continues to fluctuate. Again, as the price pulls back into that 65 to 66 area every time, there's buying, and then as it pushes back up into that upper band in a consolidating environment, this would be considered oversold, because overbought, because now we're pushing back up into that area of resistance where the old area of resistance was at. So again, immediate sell-off, bands begin to pull back into that lower range of 65 to 66, but immediate buying at 67, creating higher lows. Runs up to 70.18, pulls back, stock tries to run back up to break back out of the bands to start another uptrend, gets rejected and immediately sells off. And then as the stock pulls back, instead of finding support on that band, which it tried to right here, hence that close right above it, the following day it just broke straight through the band, and then your downtrend started. Okay, so the bands are good for adjusting and establishing oversold and overbought upper and lower limits in the price action of a stock when it is consolidating. Hence the support and resistance we was talking about earlier. That kind of goes with what we was just talking about. Now, Bollinger Bands are also good for establishing patterns, because there are pattern traders out there that look for certain type of patterns. Okay, two common patterns with Bollinger Bands is W type patterns, which are also known as double bottoms. Okay, bottom formations are generally clearer and easier to spot than top formations. The different lies in the underlying psychology. Bottoms are created in an environment of fear and pain, quite different from the environment of euphoria and hope in which tops are formed. We expect bottoms to be sharper and more tightly focused, to take less time and be more dramatic. Pain is, after all, a more insistent emotion than joy. Most frequent of all W bottoms is a low followed by a retest and then an uptrend. Okay, so I'm gonna say that again. The most frequent of all W bottoms is a low followed by a retest and then an uptrend. Price action on a strong downtrend outside its lower bands recovers to test the middle Bollinger Band before assuming its downtrend to retest the prior low established. Okay, a little more in detail. The follow-on retest of the prior low should be on lower volume, showing the selling has ceased and the price action unable to break below the band. The reversal should consist of the stock breaking above its middle Bollinger Band and holding, allowing a higher high and higher low to be established. Understand W bottoms may be transitions to base building rather than full on reversals all the time. Okay, so looking at this stock right here, this is CGC, Canopy Growth, marijuana stock. As you can see, it went on a strong downtrend, like we was talking about with Tesla. As it pulled back, hit that middle Bollinger Band, rejected, tagged the lower band, and tried to recover, rejected again, unable to make it back above its average, tagged the lower Bollinger Band, tried to recover, tagged it, made a push towards that middle Bollinger Band to try to recover, immediate sell-off, retagging the band, again, tried to make another recovery to break above that middle Bollinger Band and establish a base above it, again rejected, back into another downtrend, tries again, rejected, and then one final huge sell-off of capitulation before the stock establishes its first bottom at 1381. A lot of buying to pull it back up towards that middle band, and then the price action consolidates up under it and then breaks above it and establishes itself above the middle band. Okay, so that's what a W type bottom is. Okay, well, where's the W? The W is this one long leg coming down. All right, boom, that's the first W right here, leg down. Price action moves up to establish itself over that middle Bollinger Band, and then the price action begins to pull back. Now as the price action pulls back, it can pull all the way back down as long as it stays within the band. As the price action pulls back, it immediately recovers and then starts its upward leg. Okay, so kind of like a W. 1, 2, 3, and now it's starting its upward trend. Okay, now all W's won't come out perfect, but that is one of the patterns. One of the things you should know about a W bottom is just simply when it pulls outside of that upward band, the main thing is on its run up, you want it to retest that middle band and then establish itself above it. And then when it pulls back, you want the price action to stay in the band and not tag it again. If it does that, then it shows that one, the selling has ceased for the most part, that means there's more buying in play and it's keeping that stock from being pushed back outside that band. And then 2, you want to see that it holds above that middle Bollinger Band and it's creating higher highs and higher lows. Okay, so you have a low here with a high of 21.56, a low of 17.61 with another high of 22.25, higher low of 18.48 with a low of 18.48 with a new high of 25.64, pulling back to establish a new low, and then you'll get another run up to establish a new high. All right, so those are W type bottoms. Now patterns, M type tops. Okay, tops are quite different from bottoms, and M's are quite different from W's. The patterns are a function of psychology. Okay, pain is much sharper, more forceful emotion than greed, so panic's portrayal on the chart is much clearer. Tops are typically more complex, with the most common formation being double and triple tops. Common topping out patterns consist of a rally, a pullback, a subsequent failed test of the resistance in the neighborhood of the prior high or highs, followed by the start of a downtrend. When the top pattern fails, you will notice the price action will be unable to tag the upper band, again staying within the bands on less volume. Now, once the price action breaks below its middle Bollinger Band and unable to recover, a downtrend normally begins. Okay, so here, looking at this ticker right here, you can see you had this. Matter of fact, this is Disney. All right, so we was watching Disney. We noticed that it broke above its middle Bollinger Band, kind of establishing that W pattern we was talking about. You got that one W leg coming down, tagging a band. It went up to attempt that middle Bollinger Band. There's the first centerpiece of the W. As the price action pulled back, it did not retag the band and go outside of it, showing us that there was not a lot of selling going back into that previous bottom and more buying than anything. And then once it began that uptrend, that's your W pattern. First leg, middle part, second leg, upward leg, W. Now your M top pattern came into play here. As the price action pushed up and tagged the band, it pulled back, still holding above that middle Bollinger Band. Pushed up again on the gap up, tagging the band, pulled back, had another run up again, tagging the band, pulled back, and then on this run up right here, yes, the price action went above that upper band, but it immediately sold off and didn't hold above it, right? Which is a warning. Okay, tagged outside the band, tagging the band outside the band, push up, could not make it outside the band. So that shows you that the momentum is beginning to shift, because if the momentum was the same, then it would push outside the bands like the last two pushes. So again, to confirm the momentum is shifting, couldn't tag outside the band. As the price action begins to pull back, it tries to have another rally, and this time it doesn't even rally even close to its prior high. And then again, it pulls back, breaking below the middle band. It tries one last rally attempt, doesn't even breaks it doesn't even break above its previous high, and then again begins to fail, and that gives us forewarning that that upward momentum is beginning to shift. We are now below that middle Bollinger Band, and then all of a sudden you get a downtrend heading back down as far as Disney goes. Okay, so that's one of the M-type tops for Bollinger Bands. The key thing with the W bottoms and the M tops, the key thing is on the upward trend, the price action is constantly pushing outside of the band. Okay, if the price action ever pulls back and then it goes to try to push outside the band again and it fails to make that push, then that tells you the momentum is slowing down. Okay, because the price action cannot keep up with the wideness of the Bollinger Band due to the momentum that was initially established by the price action. Same on the W bottom. When a stock is on a strong downtrend, it will continuously tag that outside band, that lower band. The moment the stock goes to pull back and it's unable to tag the lower band again, that means the momentum is waning and it cannot keep up with the momentum established in the band when it expanded. Okay, and if the price action again goes to pull back and it stays within the band, unable to tag it, then it shows you, one, the selling has decreased, and two, that buying is coming into play. Okay, so that is a common concept with both of them. Now, John Bollinger has 15 basic rules for his Bollinger Bands. Okay, and we're just going to go through them real quick. One, Bollinger Bands provide a relative definition of high and low, which is what we talked about. Two, that relative definition can be used to compare price action and indicator or choice to arrive at a rigorous buy and sell decision. So what he's saying is, do not use the bands solely on their own. Okay, utilize them with another indicator that you are comfortable with to help confirm what you are seeing within the Bollinger Bands. Okay, if you get a M-top type setup and the price action is unable to tap that top Bollinger Band again, and your RSI is oversold, and it created a lower low on the RSI as far as divergence, those are multiple signs that the trend is slowing down and could be reversing. Okay, so that is what he's talking about in rule number 2. Number 3, appropriate indicators can be derived from momentum, volume, sentiment, open interest, intermarket data, etc. Okay. 4, volatility and trend already have been deployed in the construction of Bollinger Bands, so their use for confirmation of price action is not recommended. Okay. 5, the indicator's use for confirmation should not be directly related to one another. 2 indicators from the same category do not increase confirmation. So what he's saying is, don't use the relative strength index, which is a measure of a stock's momentum, and then use the rate of change, which is another indicator that measures the rate of change of a stock's momentum. Okay, you're getting the same confirmation, but from 2 different indicators. Number 6, Bollinger Bands can be used to clarify peer price patterns, such as M-type tops and W-type bottoms, momentum shifts, etc., which is what we just talked about. 7, price can and does walk up the upper Bollinger Band and down the lower Bollinger Band, which we just demonstrated. 8, closes outside the bands can be continuation signals, not reversal signals, as is demonstrated by the use of Bollinger Bands in some very successful volatility breakout systems. Okay, once you really get Bollinger Bands down and you come up with a breakout system, you really can time your entries and exits prior to big breakouts because you can see them coming beforehand. All right. Number 9, the default parameter of 20 periods for calculating the moving average and standard deviations, and the default parameter of 2 standard deviations for the bandwidth are just that, defaults. The actual parameters needed for any given market or task may be different. So for me, I use a 30 period simple moving average. Right, I know some people that use a 9-period moving average in their day traders, so it really just depends on you. Okay, just test out different averages, see what works for you, and give you clear signals based off your trading style and your trading psychology, and go with it. Number 10, the average deployed should not be the best one for crossover signals. Rather, it should be descriptive of the intermediate trend. So what he's saying is the Bollinger Band will help you identify crossover signals. Okay, I mean not Bollinger Bands, but the average deployed should not be the best one for crossover signals. So what he's saying is the average you choose, the simple moving average you choose for your middle Bollinger Band, should not be the one you use for a crossover signal, saying that if the price action crosses this middle band, I'm going to, if it crosses up and above, that's a buy signal. If it crosses down and below, that's a sell signal, okay? But rather it should be descriptive of their intermediate term trend, meaning the short-term trend, all right? If the price action can establish itself over that average that you decide to use as a crossover signal, it should give you an identification. If it crosses over and holds above and or below, then that gives you an identification of the intermediate term trend that is in play, okay? Hence the 20-period moving average being a short-term average, and me using the 30-period moving average, because the 30-period moving average is my short-term crossover signal that I use as far as momentum shifts. All right, number 11, I had to label it 1, but number 11, if the average is lengthened, okay, the simple moving average, the number of standard deviations to be increased simultaneously from 2 at the 20 periods to 2.1 at the 50 period. Likewise, if the average is shortened, the number of standard deviations should be reduced from 2 at 20 periods to 1.9 at 10 periods. So you just kind of want to tweak and peak your deviations along with whatever average you choose to use as a simple moving average as far as your middle Bollinger Band goes, okay? I know a lot of short-term traders use a 10-period moving average because that's what they use as their short-term average. So they tweak their standard deviations down to 1.9 or 1.8. All right, it just depends on what market you're trading and what signals you're looking for. Number 12, Bollinger Bands are based upon a simple moving average. This is because a simple moving average is used in the standard deviation calculation, and we wish to be logically consistent, okay? He wants to be logically consistent across the board, all right? Bollinger Bands have been around for a while. He's seen articles from other traders who's tweaked Bollinger Bands to use exponential moving averages. And they say it's better like that, okay? And that's their opinion, and no one's there to argue that. What John Bolilnger is saying as the creator of Bollinger Bands, the reason he uses a simple moving average and not an exponential moving average or a weighted moving average or whatever type of moving average you want to think of, is because that moving average is also averaged into the standard deviation calculation, okay? So he wants to be consistent across the board logically, all right? As you start doing different types of moving averages, different math goes into play, and if you're using different math into your exponential moving average, then a different type of math is going to play into your standard deviation, okay, which could adjust your upper and lower Bollinger Bands. Number 13, be careful about making statistical assumptions based on the use of the standard deviation calculation in the construction of the bands. The sample size and deployments of Bollinger Bands is too small for statistical significance, and the distributions involved are rarely normal. Indicators can be normalized with %B, which is another indicator he created, eliminating fixed thresholds in the process. So check out the %B if you want to use that in conjunction with the Bollinger Bands he created. Number 15, finally, tags of the bands are just that, tags, not signals. A tag of the upper Bollinger Band is not in and of itself a sell signal, and a tag of the lower Bollinger Band is not in and of itself a buy signal. So in conclusion, all right, Bollinger Bands reflect direction with the 20-period simple moving average and volatility with the upper and lower bands. As such, they can be used to determine if prices are relatively high or low. According to Bollinger, the band should contain 88 to 89% of price action, which makes a move outside the band significant. Technically, prices are relatively high when above the upper band and relatively low when below the lower band. However, relatively high should not be regarded as bearish or a sell signal. Likewise, relatively low should not be considered bullish or as a buy signal. Prices are high or low for a reason. Hence, looking at those patterns of M tops and W bottoms. Okay, just because that price action is breaking out and above that higher band does not mean it's oversold, and you need to, hey, I'm going to take a short position on this or buy puts on this, because if that price continues on you, then it's going to jack you up, okay, and put you in a hole. So that is what he's telling you, okay? As with other indicators, Bollinger Bands are not meant to be used as a standalone tool. John Bollinger suggests using them with 2 or 3 other non-correlated indicators that provide more direct market signals. He believes it's crucial to use indicators based on different types of data. Some of his favorite technical techniques are the MACD, okay, which helps you identify the trend of a stock, the on balance volume, which helps you identify the buying and selling in a stock, and the RSI, which helps you identify the short-term momentum. Okay, see how all three of those provide something different. One is giving you a trend and the strength of that trend. One is giving you the amount of buying and selling volume. The other one is giving you the short-term momentum in that stock. Okay, but these three, because they are computed from a simple moving average, they weigh older price data the same as the most recent, meaning that new information may be diluted by outdated data. Keep in mind the use of the 20-day simple moving average and 2 standard deviations is a bit arbitrary and may not work for everyone in every situation. So it's okay to change it. All right, just because you load up your stock program, your chart program, and you pull up Bollinger Bands and it has a 20 simple period moving average and a 2 standard deviation, that doesn't mean you have to stick with that. Okay, you can tweak and peak those numbers to suit your trading style, to help you better identify your signals, to help you make money. Okay, now let's go back over our learning objectives. All right, after this PowerPoint, I want you to know what you should know what Bollinger Bands are. Okay, you should understand how Bollinger Bands are calculated, understand how Bollinger Bands are constructed, understand the different concepts and theorems applied to Bollinger Bands, what information Bollinger Bands provide you as a trader, and you should know John Bolilnger 15 basic rules he applies to his Bollinger Bands, as he is the creator of them. Some of the sources I pulled my information was stockcharts.com and investopedia.com, 2 great websites with a lot of free information, and actual book Bollinger on Bollinger Bands by John Bolilnger himself. And there you have it, Bollinger Bands, TTMtrades to the moon. I really hope you guys and gals learned something from this. Hopefully you had a notepad out and you were taking notes and writing down information. So that way, if you didn't understand it, you can ask me questions and or look it up on Google. If you did not take notes, I highly suggest you go grab a notepad and or your cell phone, go back and rewatch this video, and please take notes, okay? And keep that close to your desk or your laptop or wherever you trade, so that way you can always reference those notes until that information becomes so that information gets drilled into your subconscious mind, and it becomes so natural, like driving a car, that you don't even have to read those notes anymore. Okay, so again, TTMtrades, if you love the video, please leave a comment below, hit the thumbs up, and till next time, I'm out of here.
Houston, Tranquility Base here. The Eagle has landed.